Here we have a green candle and a red candle. They are also called bars. The green bar shows that, for whatever the time frame was, the price at the end was higher than it was at the beginning. This means that the buyers had control. The red bar shows that the price was lower at the end than it was at the beginning, so the sellers had control. Bars come in different shapes and sizes, but each bar always consists of a high price and a low price, an open and a close, a body, and a tail. Different bars can mean different things. For example, a big green bar can suggest that there is a high probability that the stock will continue in the upwards direction and reach higher prices. However, this is not always true, and can even mean the opposite. To understand what action to take, you must take the location of the bar into consideration. To do this, we can use the 20 or 21 simple moving average. This is simply the average price of the previous 20 or 21 bars. As a rule, when the stock moves away from the moving average, a move back towards it should be expected. This is called a pullback, and can be a great opportunity to enter a trade. We will talk more about this in another video. If the big green bar forms near the moving average, it is likely to be followed by more green bars. If the bar forms far away, however, it is a good indication that the price will go no higher. This is the same idea for the downside. Now let's look at some real examples. Looking towards the beginning of the upwards move, you can see a green bar with a much wider range than the other recent bars, originating near the moving average. This bar sparked a significant move upwards, resulting in multiple buying opportunities, which we will look at in another video. In this next example, there are two large green bars, one after the other, followed by a relatively stable increase in price. Here's another one, but this time it's red, and so, the move we expect is towards the downside. Two bars of the same color, when one is after the other, can be considered to be one larger bar. You can therefore split this decline up into three moves, separated by two pauses or pullbacks. So we have the first move, which starts the decline, a pullback, a second move, another pullback, and finally the last move which ends the decline. Although position is very important in determining success, no trade will be successful every time. If you were to bet on follow-through from large bars like the ones we've looked at, you would be correct 8 or 9 times out of 10. This is higher than many trading methods, which is why knowing how to set a proper stop-loss and how to correctly manage a trade is incredibly important for consistent gains. By maximizing profits on a trade and ensuring the trade was entered with minimal risk, high profits can be expected. Remember to always use a demo account before attempting to trade or invest with real money, and please leave any questions you have in the comments.